You are 28 years old when your phone rings on an ordinary Tuesday afternoon. The number is unfamiliar. You almost ignore it because unknown callers usually mean telemarketers or scams. Instead, you answer. The person introduces himself as an attorney representing the estate of someone whose name you recognize immediately but haven't spoken to in over 15 years. He tells you that this person has passed away, and according to a recently executed will, you are the primary beneficiary. At first you assume there has been a mistake. You expect a small inheritance, maybe an old house or a modest investment account. Then he says a number that immediately sounds unrealistic. The estate is valued at approximately $500 million. Your first reaction is not excitement, it is disbelief. Numbers that large exist on television, in business magazines, and on stock market screens. They do not belong to ordinary people. You ask him to repeat the figure. He does. Then he calmly explains that nothing changes today. You cannot access the assets immediately. The estate must go through legal administration, ownership verification, tax review, creditor notifications, and asset valuation. The process could take several months. Until then, you legally own nothing. Over the next week, your life becomes a sequence of confidential meetings. The attorney introduces you to accountants, trust specialists, tax attorneys, wealth managers, and estate administrators. You quickly discover that inheriting wealth is not the same as receiving cash. The estate consists of commercial real estate, publicly traded stocks, private equity investments, government bonds, several operating businesses, artwork, and multiple international bank accounts. Every asset follows different legal rules. Some generate income immediately, others cannot be sold for months. Several are controlled by existing management teams that continue operating independently. Then the first serious lesson appears. $500 million is not simply money sitting inside a bank account. It is an entire financial ecosystem that continues functioning whether you understand it or not. Employees still expect salaries. Businesses still pay suppliers. Buildings require maintenance. Investment managers continue making decisions. Markets move every second. Interest accumulates. Dividends are distributed. Taxes continue to exist regardless of whether you have emotionally accepted your new reality. Your attorney gives you one piece of advice before the first official estate meeting begins. He tells you not to buy anything, not to announce anything publicly, and not to tell anyone outside your immediate legal team. Wealth changes people long before they actually spend it. The moment others believe you control extraordinary resources, every relationship begins operating under different incentives. Friends become investors, family members become negotiators. Strangers become opportunity seekers. Even honest people unconsciously begin treating you differently because every conversation now contains invisible financial possibilities. As you leave the law office that evening, the city looks exactly the same as it did that morning. Traffic still moves through the streets. People hurry home after work. Restaurants remain full. Nothing outside has changed. Yet inside your own life, every assumption about the future has quietly disappeared. You have not received a single dollar. You have signed no ownership documents. Your bank balance remains exactly the same. But one phone call has already placed you inside a completely different system, one where every decision you make from this point forward will be measured not in hundreds or thousands of dollars, but in consequences that can influence hundreds of millions. 3 weeks later, you attend the first complete estate briefing. The meeting lasts almost 6 hours. Before anyone discusses investments or future plans, the legal team spends nearly 2 hours explaining something you never considered. Inherited wealth is not transferred as a single payment. It moves through a legal framework designed to protect creditors, verify ownership, satisfy tax obligations, and preserve the estate while control changes hands. Until every step is completed, you are less an owner than a temporary steward, waiting for the system to recognize you. The attorneys begin with the balance sheet. The estate's estimated value is approximately $500 million, but that number immediately becomes more complicated. Around $200 million is invested in diversified public equities spread across North America, Europe, and Asia. Another $130 million is tied to commercial real estate producing rental income every month. Nearly $80 million sits inside privately owned companies where ownership cannot simply be liquidated overnight. The remainder consists of government bonds, cash reserves, fine art, intellectual property, and several long-term investment partnerships. On paper, you are extraordinarily wealthy. In reality, only a relatively small percentage is immediately accessible. Then comes the discussion about liquidity. One advisor explains that wealthy people rarely keep hundreds of millions in cash because idle cash loses purchasing power over time. Instead, assets remain invested, generating returns while accepting calculated levels of risk. Selling everything immediately would create enormous tax consequences, destroy long-term investment strategies, and potentially reduce the overall value of the estate. The goal is not to maximize today's spending power. The goal is to preserve wealth across decades. Next, the accountants explain ongoing obligations. Every commercial property requires maintenance contracts, insurance, security, property taxes, and management expenses. The privately held companies continue paying employees regardless of who owns them. Investment managers charge annual management fees. International assets require separate legal reporting. Even artwork stored inside secure vaults generates insurance costs. Before you spend a single dollar, millions are already moving through the system each month simply to keep the estate operating normally. Then the trust specialists introduce the structure that will ultimately control most of your inheritance. Rather than transferring every asset directly into your personal name, much of the estate will remain inside professionally managed trusts. These trusts separate ownership from day-to-day management, reducing legal exposure, improving tax efficiency, and protecting assets against future lawsuits or personal financial mistakes. It feels strange at first. You are inheriting $500 million, yet the advisors repeatedly explain why you should never personally control all of it. As the meeting continues, another realization begins to emerge. Your job is no longer earning money. Hundreds of investment professionals, executives, accountants, attorneys, and property managers are already doing that every day. Your new responsibility is making decisions about systems rather than transactions. Instead of asking whether to buy a car or a house, you now ask whether investment allocations remain balanced, whether risk exposure matches long-term objectives, whether executive teams deserve to remain in place, and whether preserving capital should matter more than maximizing returns. When the meeting finally ends, one advisor summarizes everything with a sentence that changes how you think about wealth. People imagine inheriting $500 million means financial freedom, he says. In reality, you've inherited responsibility for an economic machine that already supports thousands of contracts, hundreds of employees, dozens of businesses, and countless financial obligations. Your success won't depend on how much money you spend. It will depend on whether you understand the system well enough not to break it. Almost 4 months after the first phone call, the estate officially transfers into your control. The legal process is complete. Every creditor has been notified, every ownership document has been verified, every valuation has been reviewed, the trusts become active, corporate ownership records are updated, investment accounts are transferred, and your name now appears where someone else's stood for decades. Nothing dramatic happens. There is no celebration, no giant bank notification, and no moment where $500 million suddenly appears on your phone screen. Instead, dozens of legal documents quietly change hands, digital signatures are completed, and the financial system continues operating almost exactly as it did the day before. Your personal bank account receives its first transfer. It is not $500 million, it is $3 million. The wealth manager explains that this amount is intentionally small compared to the total estate. It provides complete financial freedom without forcing you to make decisions involving hundreds of millions before you understand the structure. Everything else remains invested exactly where it already was. The companies continue producing revenue, the office buildings continue collecting rent, dividend payments continue arriving according to their existing schedules, bond portfolios continue generating interest. The machine is already working. The objective is not to rebuild it, but to avoid interrupting it. For the first time in your life, your monthly cash flow changes more than your net worth. The estate now produces roughly $16 to $18 million annually through dividends, rental income, interest, and business distributions, depending on market conditions. After operating expenses, taxes, management costs, and reserve allocations, several $100,000 may become available every month without selling a single major asset. Your advisors explain that wealthy families rarely spend principal. They live from the cash generated by the assets themselves. If managed correctly, the estate can continue supporting future generations while its value still grows over time. The temptation to change everything arrives almost immediately. You begin making lists: a larger home, exotic cars, a private jet, luxury vacations, startup investments, charitable foundations. Friends start mentioning business ideas they have always wanted to pursue. Family members begin discussing properties that suddenly seem worth buying. Every possibility feels affordable because almost every purchase appears small compared to $500 million. That illusion is exactly what your advisors warned you about. During your first quarterly meeting, your chief investment officer shows a simple chart. If the estate grows by 7% annually while spending remains below 3%, your wealth will likely continue increasing for decades. Raise spending to 6 or 7% every year, add poorly researched investments, and ignore taxes, and even $500 million begins shrinking surprisingly fast. The mathematics are not emotional. Wealth follows arithmetic, not confidence. That afternoon, you make your first truly important decision. You buy nothing except a modest new home that comfortably fits your life and establish a written personal spending policy with fixed annual limits. The advisors seem relieved. They tell you the greatest financial mistakes almost always happen during the first 12 months, when new wealth feels unlimited and consequences still appear invisible. You leave the meeting understanding that inheriting money was never the difficult part. The difficult part begins the moment you realize the system can quietly reward patience just as easily as it can punish impulse. The first year passes far more quietly than you expected. There are no yachts, no private islands, and no dramatic lifestyle transformation. Instead, your calendar fills with meetings that never existed before. Every Monday begins with an investment update. Every month includes a review of cash flow, property performance, and portfolio allocation. Every quarter brings meetings with accountants, attorneys, auditors, and trust administrators. You no longer think in terms of purchases. You think in terms of percentages, risk exposure, liquidity, and long-term preservation. Without realizing it, your daily routine has shifted from earning money to managing an economic system. The biggest surprise is that wealth creates decisions even when you make none. Every week, acquisition proposals arrive from investment banks. Real estate developers invite you into billion-dollar projects. Venture capital firms promise extraordinary returns through exclusive opportunities. Private equity funds present carefully prepared presentations, explaining why their strategy deserves $20 or $30 million of your capital. On paper, each proposal looks reasonable. Collectively, they would expose hundreds of millions to risks you barely understand. At the same time, your personal life begins changing in subtle ways. Friends start asking unusual questions. Some casually mention investment opportunities during dinner. Others wonder whether you would consider becoming a silent partner in their business. Distant relatives suddenly remember birthdays they ignored for years. Former classmates reconnect after a decade of silence. None of these conversations begin with money, but almost all of them eventually arrive there. You notice a pattern. The larger the request, the longer people spend pretending that the request is not coming. Your advisors teach you another principle that wealthy families follow almost automatically. Every decision now carries an opportunity cost. Buying a $50 million yacht is not simply spending $50 million. It also means giving up the future income that $50 million could generate if it remained invested. At an average annual return of 7%, that same capital could potentially produce more than $3 million every year before taxes. Luxury is no longer measured only by its purchase price. It is measured by everything the money could have become instead. Eventually, you create a personal rule that surprises almost everyone around you. No investment, no matter how attractive it appears, receives funding after a single meeting. Every proposal must survive independent legal review, financial due diligence, tax analysis, and at least 30 days of waiting before you even consider approving it. Some people call you overly cautious. Others lose interest immediately because they were hoping for quick decisions. Your advisors quietly approve. They explain that most catastrophic financial mistakes happen because wealthy people confuse access to capital with the ability to evaluate risk. By the end of the first year, your life looks comfortable from the outside but highly structured from the inside. The inheritance has not made you impulsive. It has made you disciplined in ways you never expected. Yet one uncomfortable realization continues growing in the background. The system protecting your wealth depends entirely on your ability to continue making rational decisions. The moment confidence replaces discipline, the structure that preserved $500 million for decades can begin weakening surprisingly fast. The second year begins with a realization that no financial advisor mentioned during your first estate meeting. Money does not simply increase your purchasing power, it changes the incentives of nearly everyone around you. Very few people openly ask for $5 million. Instead, they ask for opportunities, introductions, partnerships, guarantees, or temporary help. Every request sounds reasonable when viewed individually. Together, they become a constant stream of decisions that slowly consume more time than managing the estate itself. The first requests come from family. A cousin wants funding for a restaurant that banks refuse to finance. An uncle explains that a commercial property would be a perfect investment if you simply provided the capital. A sibling asks whether you could purchase a vacation home that everyone would share. None of them believe they are asking for charity. Each person genuinely believes they are presenting a profitable opportunity that benefits everyone involved. Refusing feels emotionally expensive. Accepting creates expectations that never disappear. Outside the family, the scale increases dramatically. Financial advisors you have never met request meetings. Entrepreneurs send business plans almost every week. Startup founders promise that a $10 million investment today could become $100 million within 5 years. Charity organizations invite you to exclusive fundraising dinners. Universities offer honorary positions. Political campaigns ask for support. Private banks compete to manage your assets. Every institution treats your attention as something valuable because your capital has become valuable. Then come the professional opportunists. Luxury developers offer private tours of properties before they reach the market. Investment clubs advertise exclusive deals available only to ultra-high net worth individuals. Wealth consultants promise strategies capable of outperforming the market by several percentage points every year. Each presentation is polished. Each proposal includes impressive graphs, historical returns, and carefully prepared forecasts. Most are not outright scams. The real danger is that nearly all of them underestimate risk while emphasizing potential reward. Your calendar begins filling with conversations that produce almost no actual decisions. You spend hours listening to presentations that lead nowhere. Every meeting requires legal review, financial analysis, background investigations, and independent verification before any capital can move. The advisors you hired now spend as much time rejecting opportunities as evaluating them. Surprisingly, saying no becomes one of the most valuable financial skills you develop. Eventually, your chief investment officer performs an unusual calculation. During the previous 12 months, you received proposals requesting a combined total of more than $1.3 billion in funding, nearly 3 times your total inheritance. If you had accepted only 1 out of every 5 requests, the estate would already be dangerously overexposed to concentrated private investments with uncertain outcomes. The requests themselves were never the problem. The volume was. That evening, you update one rule inside your family's governance policy. Every financial request, regardless of who makes it, follows exactly the same process. Independent analysis, external due diligence, formal documentation, cooling off period, final committee review, no exceptions for relatives. No exceptions for friends, no emotional shortcuts. Some people quietly disappear from your life after hearing that policy. Others become frustrated that money now requires paperwork instead of trust. For the first time since inheriting the estate, you understand that protecting wealth is often less about finding extraordinary investments and more about resisting ordinary pressure. $500 million does not disappear because of one catastrophic mistake. More often, it disappears one reasonable request at a time, until emotion quietly replaces structure and discipline slowly gives way to obligation. For almost 2 years, your discipline protects the estate. Every proposal passes through lawyers, accountants, investment analysts, and independent consultants before receiving approval. Returns remain stable. Commercial properties continue producing predictable income. The equity portfolio grows alongside the market. Your advisors begin describing your management style as conservative, which they consider a compliment. The system functions exactly as it was designed to. Then something changes, not in the market, but in your confidence. You begin believing that you understand the system well enough to identify opportunities before everyone else does. After attending hundreds of investment meetings, reading thousands of pages of financial reports, and watching dozens of successful acquisitions, you start recognizing patterns, or at least you think you do. You convince yourself that experience has replaced the need for patience. The opportunity arrives through someone you trust. A close friend introduces you to the founders of a rapidly growing artificial intelligence company. Unlike previous proposals, this one feels different. The founders are intelligent. The technology appears genuine. Independent analysts confirm that demand for AI infrastructure is expanding quickly. Venture capital firms have already invested significant amounts, and several well-known executives have joined the advisory board. Normally, your process would take 6 weeks. This time, it takes 12 days. You still involve your legal team, but you quietly shorten the due diligence process. Certain market risks receive less attention because the overall narrative seems overwhelmingly positive. You focus more on projected growth than downside scenarios. Instead of asking what could destroy the investment, you spend most meetings discussing how valuable it might become if everything works perfectly. Eventually, you approve a $60 million investment. It represents only 12% of your total wealth, which makes the decision feel relatively safe. Even if the company failed completely, the estate would survive. That calculation becomes your justification. What you fail to notice is that the absolute size of the investment matters less than the decision-making process that produced it. For the first time since inheriting the estate, you modified the rules instead of following them. The first few months reinforce your confidence. The company's valuation doubles during another funding round. Financial media describe it as one of the fastest-growing private technology firms in the country. Investors congratulate you. Friends begin calling you unusually talented at spotting opportunities. Even your advisors admit the investment appears promising, although several quietly remind you that unrealized gains are not the same as realized profits. Then small warning signs begin appearing. Revenue growth slows slightly. One major customer unexpectedly delays renewing a contract. Operating expenses increase faster than management originally projected. None of these problems seem catastrophic individually. Startups experience temporary setbacks all the time. The founders remain optimistic during quarterly presentations, explaining that expansion always creates short-term volatility. You want to believe them. More importantly, you want to believe yourself. Instead of becoming more skeptical as uncertainty increases, you become emotionally invested in proving your original decision was correct. You attend more meetings. You ask fewer difficult questions. Every new piece of positive information feels more convincing than every negative one. Without realizing it, you stop evaluating the investment objectively and begin defending it psychologically. For the first time since inheriting $500 million, your greatest risk is no longer market volatility or economic recession. It is your own confidence. 6 months after your investment, the first serious problem becomes public. The company announces that several projected contracts have been postponed indefinitely. Officially, nothing has failed. The explanation sounds reasonable. Large enterprise customers simply need more time. Management insists that demand remains strong, and long-term expectations have not changed. Financial media barely react. The valuation remains high. Most investors continue believing the story. Inside your own advisory team, however, the atmosphere changes immediately. During the next quarterly investment meeting, your chief risk officer places 2 charts on the screen. The first shows the company's original financial projections from the day you invested. The second shows actual performance. Revenue is growing at less than half the expected rate. Customer acquisition costs have increased by nearly 40%. Cash reserves are declining faster than forecast. The company is still operating, but the assumptions supporting its valuation are beginning to weaken. For the first time, your advisors recommend preparing an exit strategy. You hesitate. Selling now would mean admitting that your original judgment may have been wrong. More importantly, the company has not collapsed. There is still a realistic possibility that management recovers over the next 12 months. You convince yourself that temporary volatility should not influence long-term investing. After all, every successful company experiences difficult periods. Technically, that statement is true. The problem is that you are no longer evaluating probabilities. You are protecting your previous decision. Over the following months, additional warning signs appear one after another. A senior executive unexpectedly resigns. Another funding round is delayed. Independent analysts quietly reduce their growth expectations. Industry competitors begin releasing stronger products than anyone anticipated. None of these developments destroys the company individually, but together they form a pattern that becomes increasingly difficult to ignore. Your investment committee schedules an emergency review. The meeting lasts almost 8 hours. Every advisor around the table presents evidence supporting a more conservative approach. Several recommend reducing exposure while secondary markets still provide liquidity. Others argue for accepting a moderate loss today instead of risking a much larger one later. They are not emotional. They simply follow the same disciplined framework that protected the estate for years. You notice something uncomfortable. Every argument made by your advisors resembles arguments you yourself would have accepted before making this investment. Yet now you challenge every recommendation. You ask whether analysts might be overreacting, whether market sentiment could reverse, whether new contracts might still appear, whether competitors are actually weaker than they seem. Every question searches for reasons to keep believing instead of reasons to reassess objectively. Your chief investment officer finally says something that silences the room. This discussion is no longer about the company, he explains. It's about whether we're protecting $60 million or protecting your confidence. The sentence stays with you long after the meeting ends. That evening, you review every document from the original investment. You realize something that had remained invisible for months. The company's condition has certainly changed, but the larger change happened inside your own decision-making process. The rules that governed every previous investment were designed specifically for moments like this. Yet the moment those rules challenged your own judgment, you quietly stopped trusting the system and started trusting yourself. For the first time since inheriting the estate, the greatest instability is no longer inside the investment portfolio. It is inside the person making the decisions. 2 years earlier, you believed that owning $500 million meant having unlimited control over your future. Now you discover something very different. Wealth does not eliminate uncertainty. It simply increases the scale at which uncertainty operates. The more assets you manage, the more systems become interconnected, and the harder it becomes to isolate one mistake from everything surrounding it. The AI company announces another funding round, but this time the terms are dramatically different. New investors are only willing to provide capital if the company's valuation is reduced by more than 60%. Existing shareholders must either contribute additional money to maintain their ownership percentage or accept significant dilution. The founders recommend participating. They argue that temporary market conditions are creating an opportunity rather than a crisis. If the company survives another 18 months, they believe the valuation could recover. Your advisors disagree almost unanimously. The finance team presents 3 scenarios. In the optimistic case, contributing another $25 million eventually restores the company's value and produces a respectable long-term return. In the base case, additional funding merely delays deeper structural problems while increasing total losses. In the pessimistic case, the business continues consuming capital until bankruptcy becomes unavoidable. None of the scenarios offers certainty. Every option now carries meaningful risk. For the first time since inheriting the estate, there is no objectively correct decision. You begin requesting additional reports, outside consultants, independent valuations, and industry experts. Every new opinion introduces another interpretation rather than another answer. Some specialists believe artificial intelligence remains the future of global business. Others argue that unrealistic expectations have inflated the entire sector. Several respected investors continue supporting the company. Others quietly exit without public explanation. More information no longer creates clarity. It creates complexity. While you focus on the investment, the rest of the estate continues operating. Commercial properties still require capital improvements. Public markets experience increased volatility. Interest rates change, affecting bond valuations. Currency movements influence international assets. Business managers request approval for expansion projects. The estate never pauses simply because one investment demands your attention. Every hour spent trying to rescue one decision becomes an hour not spent managing dozens of others. Your calendar slowly transforms. Instead of discussing long-term strategy, almost every meeting revolves around one struggling investment. The company occupies a disproportionate amount of your time despite representing only a fraction of your total portfolio. Without noticing it, you begin managing the estate around your mistake, instead of managing your mistake within the estate. Eventually, your chief investment officer prepares one final analysis. He removes every company name, every founder biography, every newspaper article, and every emotional detail. The presentation contains only numbers, current valuation, remaining cash reserves, revenue trajectory, customer retention, capital requirements, expected probabilities. Looking only at the data, the recommendation becomes obvious. You would never approve this investment today if it were presented for the first time. He closes the presentation with a single question. If this opportunity arrived on your desk this morning, would you invest $85 million into it? The room remains silent. Because you already know the answer. No. That realization changes everything. You finally understand that you are no longer deciding whether to keep an investment. You are deciding whether to admit that the investment you already made no longer deserves additional capital. The illusion of control disappears completely. The market never promised certainty. The advisors never promised certainty. The only promise they ever made was that disciplined systems outperform emotional decisions over long periods of time. And somewhere along the way, you stopped following the system you inherited. You authorized the sale. Not because the company has failed completely, but because the numbers no longer justify your optimism. The secondary transaction closes 6 weeks later. After dilution, reduced valuation, legal fees and market discounts, the estate recovers only $32 million from what had once been an $85 million position. More than $50 million has disappeared. The loss represents barely 10% of your total wealth. Financially, the estate remains extraordinarily healthy. Psychologically, the impact is much larger. For weeks, you replay every decision in your mind. You revisit old presentations, emails, meeting notes, and legal opinions. You stop asking why the company failed and begin asking why you ignored the system that had protected the estate from the beginning. The answer slowly becomes uncomfortable. You did not lose money because markets became unpredictable. Markets had always been unpredictable. You lost money because, at one critical moment, confidence became more persuasive than discipline. The quarterly performance report arrives shortly afterward. Overall, the estate has still generated positive returns over the previous 3 years. Commercial real estate continues producing stable rental income. The diversified stock portfolio has appreciated steadily despite periods of volatility. Government bonds have provided predictable cash flow during uncertain markets. Several privately owned businesses have exceeded expectations. Excluding the AI investment, the estate has performed almost exactly according to the long-term strategy established during the first estate meeting. Your advisors point toward the report. One mistake did not destroy the fortune. One mistake simply interrupted the mathematics. That distinction matters. You begin studying wealthy families that preserved capital for generations instead of decades. Their common characteristic is not extraordinary intelligence. It is institutional discipline. They assume they will eventually make emotional decisions, which is precisely why they build systems that make emotional decisions difficult to execute. Investment committees, independent audits, formal approval processes, diversification rules, and written governance policies all exist for one reason: to protect wealth from its own owners. Looking back, you realize the estate had warned you long before the financial loss occurred. The first warning was shortening your due diligence process. The second was believing your judgment had become exceptional. The third was defending a previous decision instead of evaluating current facts. By the time money disappeared, the real collapse had already happened months earlier inside your decision-making process. You make one final change. From now on, every investment above $10 million requires unanimous approval from your independent advisory committee. If even one member believes the analysis is incomplete, the proposal automatically returns for additional review. You voluntarily give away part of your own authority because you finally understand something that seemed impossible 3 years earlier. Unlimited control is not an advantage, it is a risk. As the meeting ends, your chief investment officer quietly closes the report and says something that perfectly summarizes everything you have learned. People think fortunes disappear because markets crash. In reality, fortunes usually disappear because intelligent people slowly convince themselves they no longer need the rules that created the fortune in the first place. 5 years have passed since the phone call that changed your life. If someone looked only at your balance sheet, they would probably assume the story was about becoming unimaginably wealthy. In reality, it became a story about learning the limits of control. The estate is now worth slightly more than it was when you inherited it. Despite the failed investment, disciplined portfolio management, appreciating real estate, growing businesses, and consistent market returns have gradually recovered the losses. Financially, the system proved stronger than any individual decision. That realization becomes the most valuable lesson of all. Your life today is almost unrecognizable compared to the one you imagined during those first weeks. You no longer check your personal bank account every morning. You rarely think about the price of ordinary purchases. Money has quietly disappeared from your daily decision-making because the estate produces enough income to support your lifestyle indefinitely. Ironically, once financial survival is permanently solved, financial consumption becomes far less interesting. Instead, your attention shifts toward protecting the structure itself. Every quarter, you still meet with the investment committee. Every major allocation still passes independent review. Auditors continue examining financial statements. Attorneys regularly update trust documents to reflect changing tax laws. Risk managers stress test the portfolio against recessions, inflation, geopolitical crises, and market crashes. None of these meetings feel exciting anymore. That is precisely why they work. Wealth survives through routine rather than extraordinary moments. Friends occasionally ask what it feels like to inherit $500 million. Most expect stories about private jets, luxury homes, or exotic vacations. Instead, you tell them something much simpler. The inheritance never truly changed your lifestyle. It changed your responsibility. Before, every financial decision affected one person. Now, every decision influences employees, tenants, business partners, investment managers, charitable foundations, and future generations that may one day inherit the same system. The money was never simply yours. You became its temporary steward. Looking back, you realize the greatest misconception about extreme wealth is the belief that it creates freedom from consequences. The opposite is true. The larger the fortune becomes, the more every decision compounds. A 1% mistake on a modest savings account may go unnoticed. A 1% mistake inside a $500 million estate represents $5 million. Scale magnifies judgment far more than it magnifies comfort. When you think about the attorney's phone call years ago, you barely remember the number he mentioned. You remember his first piece of advice. Tell no one, buy nothing, change nothing until you understand what you've inherited. At the time, it sounded unnecessarily cautious. Now you understand it was the foundation for everything that followed, because the true inheritance was never $500 million. It was a financial system that had survived for decades through discipline, structure, and patience. The moment you believed you were smarter than that system, you almost destroyed part of it. The moment you learned to trust the system again, the fortune began protecting itself once more. That is what actually happens after inheriting $500 million. The money changes your life on the first day. Understanding what to do with it changes you over the next 5 years.